Intel is collapsing. The day I'm recording this video, Trump asked the CEO to resign. Its stock is down, its competitors are crushing it, and even its once loyal investors are starting to ask, is it over? This isn't just about a bad quarter, it's about a company that missed the biggest shifts in tech, mobile, AI, GPUs, and is now paying the price. While NVIDIA prints money with AI chips and AMD keeps stealing market share, Intel is pouring billions into factories, hoping to stay relevant. In this video, we're going deep into the full story, the numbers, the strategy, and the risks. Is this a comeback story in the making, or is it time to sell before things get worse? Let's find out. But please don't forget to follow the channel because it motivates me to continue. First, let's understand all that Trump and Intel CEO thing. It started when Donald Trump, in a post on Truth Social, called for Intel's new chief executive, Lip-Bu Tan, to resign. No detailed evidence, just a broad accusation that Tan was highly conflicted. That one sentence lit a fire. Why? Because Intel isn't just another company, it's the only US-based manufacturer capable of producing the most advanced chips in the world. If the CEO's loyalty or judgment is in question, it's not just a corporate drama, it becomes a national security conversation. And it didn't stop with Trump's post. Senator Tom Cotton, head of the Senate Intelligence Committee, sent a letter to Intel's board raising concern about the security and integrity of the company's operations, specifically Tan's past ties to China. Those ties aren't made up. Tan has been a prolific investor in Chinese tech companies, including China's largest chip maker, Semiconductor Manufacturing International Corp. His San Francisco-based venture capital firm has also backed companies in Hong Kong. And before taking over at Intel earlier this year, Tan ran Cadence Design Systems, which just admitted to violating US export controls by selling chip design tools to a Chinese university linked to the military. So the optics, not great, especially in an era where US-China tech tensions are at boiling point. But Tan didn't just sit quietly. Hours after Trump's post, he sent a letter to Intel staff calling the criticism misinformation and insisting that in more than 40 years in the industry, he's always acted with the highest legal and ethical standards. He said Intel was engaging with the Trump administration to clear the air and that the company's board was fully supportive of the transformation plan he's leading. And it's worth noting, Tan isn't exactly steering a ship in calm waters. He's in the middle of a massive cost-cutting push and has even warned that Intel might abandon its next-generation manufacturing technology if it can't land a big external customer. That's the same 18A technology that's supposed to put Intel back in the fight with TSMC and Samsung. The subtext here is heavy. Trump is framing this as a national security risk. Tan is framing it as political noise. And caught in the middle is Intel, a company already fighting to survive in the most competitive, geopolitically charged tech race in decades. The real question? Whether this turns into a short-lived headline or the start of a much bigger political storm that could shake investor confidence right when Intel needs stability the most. Okay, but now let me explain to you why Intel is doing so badly and the stock has been falling consistently. Picture this. For decades, Intel was the king of chips. If your computer had a brain, chances were it had the little blue Intel Inside sticker. They dominated PCs, they dominated servers, and they printed money like few companies in history. But here's the thing about being on top for too long, it can make you slow, comfortable. You start believing the future will look like the past, just with shinier parts. And while Intel was polishing its crown, the battlefield changed completely. The first big miss? Mobile. When the world's computing power started moving into pockets and handbags, Intel stuck to its PC fortress. Apple came knocking, asking Intel to make chips for the iPhone. Intel said no. That no turned into a fortune for ARM-based designs, and Apple eventually built its own chips. Chips so good they kicked Intel completely out of MacBooks years later. Then came GPUs and AI accelerators. NVIDIA, once a graphics card company for gamers, realized that their chips could also power machine learning. They bet big. AMD followed. Intel, they kept selling CPUs. Powerful, yes, but not the kind of chips that train giant AI models. By the time Intel tried to join the AI race, NVIDIA was already selling gold mines to anyone who wanted to dig. Fast forward to today, and Intel looks like the giant who finally woke up, but in a sprint that's already halfway done. They've announced bold plans, billions in new factories in the US and Europe, a new manufacturing process called 18A that's supposed to leapfrog the competition, and AI PCs that promise to put artificial intelligence into everyday laptops. Sounds exciting, right? The problem is, factories don't make you money until they're finished and filled with paying customers. And that's the other big catch. Intel's new foundry business, the part where they hope to make chips for other companies, is still mostly making chips for itself. External customers are rare. The foundry division is losing billions every year. Meanwhile, their core businesses aren't firing on all cylinders. PCs, still their biggest source of revenue, are flat. People aren't buying laptops like they did during the pandemic. Servers, once an Intel stronghold are bleeding market share to AMD, whose EPIC processors are cheaper, more efficient, and better for data centers. AI, the gold rush of the decade, is dominated by NVIDIA, with AMD gaining ground. Intel is mostly selling CPUs that sit next to those AI chips, not the chips everyone is fighting for. Intel isn't dead, far from it. They still have unmatched engineering talent, deep relationships with PC makers, and government backing for US chip production. If their 18A process delivers and they land big foundry customers, this could turn into one of tech's great comeback stories. So, after all the headlines, the politics, and the leadership drama, what do the numbers actually say? Is Intel a hidden asymmetric opportunity, or is it just a slow-moving giant headed nowhere? Right now, the scoreboard doesn't look flattering. Last quarter, Intel pulled in $12.9 billion in revenue, the same as a year ago. No growth. Earnings came in at a loss of $0.67 per share under GAAP, dragged down by almost $3 billion in restructuring costs and asset write-downs. Even adjusting for those one-offs, the company still lost money. Gross margins, just 27.5%. For context, NVIDIA runs at more than 75% and AMD hovers around 50%. That margin gap is the difference between printing cash and fighting to breathe. The foundry business, Intel's big bet to become the go-to manufacturer for other companies, is still deep in the red. It lost $7 billion in 2023, and management admits it may not break even until 2027. Until then, it's a massive drag on profitability. On top of that, capital expenditures this year are expected to hit $18 billion, money that needs to start earning a return fast. But here's where it gets interesting. The market is pricing Intel like a company in terminal decline. Its price-to-sales ratio is just 1.6x compared to AMD at around 9x and NVIDIA at over 40x. That's the kind of multiple you normally see in mature, low-growth industrials, not in a company sitting at the center of the global chip supply chain. If Intel can fix its manufacturing and win even a few large foundry contracts, margins could climb and that multiple could re-rate quickly. The problem is the timeline. Every quarter without a margin rebound burns cash and erodes confidence. The foundry turnaround is high risk. No one other than TSMC has proven they can do leading-edge manufacturing profitably at scale. And in AI, Intel isn't selling the high-margin accelerators that are in insane demand. It's mostly selling CPUs that sit next to them. That's a less glamorous and less lucrative position to be in. So, is it asymmetric? In theory, yes. The downside feels limited because the stock is already priced for mediocrity, while the upside, if they execute, could be significant. But this is not a quick trade. It's a multi-year bet on execution, government backing, and the hope that Intel can reclaim a place in the most advanced corner of the chip market before the cash burn forces harsher cuts. In other words, Intel today isn't for momentum chasers. It's for patient, deep value investors willing to risk being wrong for years in exchange for the chance of being very right all at once.